Partnership, the strategic players. So when it comes to the partnership, your success under the new tax law hinges entirely on how well you plan and structure your entity. Multi-members LLC are taxed as partnership can absolutely benefit from the QBI deduction, but the key is in how income is allocated, how depreciation is used, and how proactive your planning is. So unlike sole proprietorship or S corporate ownership, partnership offer more flexibility, but also more room for the error. Your gains will depend on whether your partnership agreement, allocation methods, and investment strategies are optimized for your tax efficiency. So here are some strategic opportunities for the partnership. Number one, the cost segregation on the real estate. Absolutely love this one and use this all the time for myself and my clients. Accelerated depreciation through cost segregation allows you to front load deductions and free up cash flow, especially powerful in the partnership with the real estate assets. Number two, equipment and technology purchase. The 100% bonus depreciation is back. When timing properly, these purchases can dramatically reduce your taxable income, especially if used before December 31st. And number three, defined benefit and retirement plans. The partnership can supercharge retirement savings with pension plans, especially for the high-income partners nearing retirement. And lastly, number four, optimize profit allocation. Your K1 income doesn't have to be split 50-50 like it's in a S corporation. Strategically, allocation based on time, capital, or performance can lower for the collective tax burden and maximize available deduction. Let me give you an example so you can actually see how it works. So a real estate partnership, they're using this cost segregation power play. So the scenario is there's three partners and they purchase a commercial property which costs 2.4 million. And they're utilizing the cost segregation study, the accelerated depreciation. By doing the cost segregation study for the year one, they're taking advantage of the bonus depreciation that allows them to deduct $920,000 in one single year from the 2.4 million of that purchase of the commercial property. So now, because there's three partners, we're splitting this 920 among three partners. So that loss can potentially create a tax savings between $61,000 to $102,000 per partner, depending on the bracket. So here's the key takeaway. Strategic depreciation through cost segregation turns paper losses into real tax savings. Here's another example that I would like to share with you. The medical professionals are among our favorite clients because we understand the unique financial and operational challenges they face. So here's an example. The medical partnership, they purchase the equipment and at the same time they're using the pension strategy. So there's two doctors, they earn $850,000 in total in profits in a single year. So now here's the strategy that we're using. They're purchasing the equipment that cost $160,000. Because of the bonus depreciation that we're utilizing in this strategy, we're deducting the whole $160,000. And at the same time, they're utilizing the retirement strategy contribution. So they're contributing $180,000 into a defined benefit plan. So the total deduction is $340,000. So that means that it reduces the taxable income per partner of $170,000. So what it means, it reduces the taxable income per partner in amount of $170,000. And this gives them a total tax savings between $40,000 to $63,000 per each partner. The key takeaway, combine these two strategies and then you slash your taxes dramatically while building wealth. So here's the bonus strategy that I would like to share, using a passive losses from one deal to offset income from another. Here's a powerful but underutilized strategy. Allocate more of the K1 profits to the partner in lower tax bracket to reduce the partnership total collective tax liability. So now let's say your partnership owns multiple businesses or properties. One venture generates significant income while another has a paper losses due to depreciation or cost segregation. With proper planning, you can allocate that losses strategically to reduce taxable income on the profitable side. So let me just share with you an example. So let's say it's a partnership and they have one deal, a newly purchased apartment building. With doing the cost segregation, they were able to create the deduction of $200,000 for the cost segregation. So now, if we take this $200,000 and divide among the partners, which are 50-50, giving them the standard allocation, then this will give each partner $100,000 in income from the deal. But what if one partner, let's say partner A, his income is much higher this year due to other deals, while the other partner, partner B, has a lower income. So here's the strategic move. Allocate more of this $200,000 loss to the partner A that has legally higher income based on their level of involvement or capital contribution. Let me just show you numbers what it would look like. So the partner A, he has already $200,000 in income from other deals. Now, instead of splitting the loss 50-50, we're giving him this $150,000 in loss. So that creates $50,000 in income. And then partner B, his income from other sources is only $100,000. So we're allocating $50,000 loss to him. So that gives him $50,000 taxable income. So the outcome, both partners pay tax only on $50,000 at a lower marginal rate versus if they would have paid at much higher rate for the partner A. So the overall partnership tax burden is now reduced and potentially can save them between $15,000 to $25,000 just by using this allocation strategy. So why it works? The IRS allows flexible profit loss allocation as long as it's detailed in the partnership agreement and has a substantial economic effect. So here are the action steps for the partnership. Number one, review your partnership agreement. If it hasn't been updated in years, then it may be costing you thousands of dollars. Number two, plan purchases before December 31st. If you're thinking that you will need next year to buy an equipment, software, or technology, then purchase it this year. So this way you can deduct and take full deductions this current year. And lastly, number three, talk to a tax strategist, especially if you're planning to sell real estate or buy property or bring new partners on board. Partnership can be one of the most powerful structures for the growth and tax planning if you take advantage of the flexibility and plan proactively.